If crude oil spikes to $200 a barrel, it won't just be a price jump, it will be an economic earthquake that sends shockwaves through every corner of the global financial system. I am Eric from Market Meridian. Most investments will get crushed under the weight of skyrocketing energy costs, collapsing demand, and relentless inflation. Stocks will crash as corporate profits evaporate, banks will struggle to manage bad loans and liquidity shortages, and the housing market will collapse under the burden of soaring mortgage rates and plummeting property values. This isn't fearmongering, it's a cold, hard reality of how intertwined oil is with every aspect of modern economies, from manufacturing and transportation to agriculture and consumer spending. But here's the critical truth: not all assets will crumble. Some will not just survive this crisis, they will thrive. They are the natural hedges against inflation, energy chaos, and currency devaluation, designed to weather even the most severe economic storms. Today, I'll show you exactly which assets to hold onto for dear life, which to sell immediately before they destroy your wealth, and how to structure a defensive portfolio that will protect you from the worst of the $200 oil shock. This isn't just a guide, it's your survival plan for a world where energy costs dictate every financial decision. This is the survival guide you need for a $200 oil world. Before we dive into the assets that will save your portfolio, let's quickly recap. Exactly what happens when oil hits $200 a barrel, because understanding the crisis is the first step to surviving it. The impact is systemic, rippling through every layer of the economy, and it all starts with inflation first. Inflation explodes higher. Oil is the lifeblood of the global economy. It powers cars, heats homes, fuels factories, and is a key input in countless products, from plastics and fertilizers to cosmetics and pharmaceuticals. When oil prices double or triple, the cost of nearly everything rises with it. This isn't just transitory inflation, it's persistent, entrenched inflation that erodes the purchasing power of every dollar you hold. Prices at the grocery store, the gas pump, and the utility bill will surge, leaving consumers with less money to spend on non-essential goods, which in turn crushes corporate revenue. And next, central banks are forced to raise interest rates, again, and aggressively. Their primary mandate is to control inflation, and when it spirals out of control, the only tool they have is to hike rates to cool demand. But this is a double-edged sword. Higher rates make borrowing more expensive for businesses and consumers, which further slows economic growth. We saw this in 2022 and 2023, when central banks raised rates to combat post-pandemic inflation, and it will only be worse with $200 oil. Rates could climb well above 6% in the US, and even higher in other countries, as central banks scramble to contain the inflationary fire. As a result, economic growth collapses. Businesses can't afford to borrow money to expand, hire, or invest. Consumers can't afford mortgages, car loans, or credit card debt. Demand for goods and services plummets, leading to layoffs, reduced production, and a full-blown recession, possibly even a depression. The International Monetary Fund, IMF, estimates that a sustained $100 increase in oil prices could reduce global economic growth by 2 to 3 percentage points, and a $200 price tag would be far more devastating. Finally, most stocks, bonds, and real estate fall hard. Stocks decline as corporate profits shrink and investors flee risk. Bonds crash as interest rates rise, bond prices and rates move in opposite directions. Real estate collapses as mortgage rates become unaffordable, demand dries up, and property values plummet, especially in areas dependent on energy-intensive industries. But here's the key distinction: not all assets behave the same way. Some are built to withstand, and even benefit from, the chaos of $200 oil. These assets are natural hedges against inflation, energy shortages, and currency devaluation, and they will be your lifeline in the storm. Let's break them down. When oil hits $200 a barrel, the investment landscape will split into two camps: assets that get crushed, and assets that thrive. The ones that thrive share a common trait: they either benefit directly from high oil prices or act as safe havens when the financial system is under stress. Here are the classes you need to hold, in detail. 1. Energy and commodity producers. This is the most obvious winner, and for good reason. These companies benefit directly from high oil prices, and their profits will skyrocket as the rest of the economy struggles. The logic is simple: their costs, drilling, production, infrastructure, stay relatively stable, but their revenue explodes as the price of oil climbs. In a $200 oil environment, these companies become cash machines, generating massive profits that translate to higher stock prices, bigger dividends, and stronger balance sheets. Let's break down the key subsectors to focus on. First, integrated oil and gas giants. These are the large, established companies like ExxonMobil, Chevron, and BP, which have operations across the entire oil and gas value chain, from exploration and production to refining and distribution. Unlike smaller companies, they have the scale and financial resilience to weather short-term volatility, and they benefit from both high oil prices, from production, and high refined product prices, from refining. Even better, many of these companies have been returning cash to shareholders through stock buybacks and dividends, which will only increase as profits surge. As of 2026, major oil giants have already started ramping up production in anticipation of higher prices, positioning themselves to capitalize on a $200 oil scenario. Second, oil exploration and production, E&P, firms. These companies focus solely on finding and extracting oil and gas, so their revenue is directly tied to oil prices. When oil hits $200, their profits will multiply, especially for companies with low production costs, like those operating in the Permian Basin in the US or the Middle East. Smaller E&P firms may be more volatile, but they offer higher upside potential than the integrated giants. Additionally, oilfield services companies, those that provide drilling, fracking, and other support services to E&P firms, will also benefit, as higher oil prices lead to increased drilling activity. Third, coal, natural gas, and energy infrastructure. When oil prices soar, many industries and countries will switch to alternative energy sources to reduce costs, and coal and natural gas will be the primary beneficiaries. Coal is still a major source of electricity in many countries, including China and India, and natural gas is a cleaner alternative to oil for heating and power generation. Companies that produce coal and natural gas, as well as those that operate pipelines, storage facilities, and LNG, liquefied natural gas, terminals, will see a surge in demand. Energy infrastructure companies, in particular, offer stable cash flows through long-term contracts, making them a more defensive play within the energy sector. Notably, geopolitical tensions in key oil shipping routes like the Strait of Hormuz have already boosted demand for alternative energy sources, a trend that will accelerate if oil hits $200.20. Precious metals. Gold and silver are timeless safe havens, and they will shine brighter than ever in a $200 oil world. For centuries, these metals have been a store of value during times of crisis, and a $200 oil shock will be no exception. They thrive in 4 key scenarios, all of which will be present when oil hits $200: high inflation, currency devaluation, geopolitical chaos, and systemic financial stress. High inflation erodes the value of fiat currency, like the US dollar, euro, or yen, but gold and silver hold their value. When prices rise, people turn to precious metals to preserve their wealth, driving up demand and prices. As of March 2026, London gold is already trading at over $5,000 per ounce, and silver at over $80 per ounce, levels that would likely surge to new all-time highs if oil hits $200, as inflation spirals and investors seek safety. Even a slight dip in gold prices, like the 0.37% increase seen in recent days, is a temporary blip in the long-term upward trend driven by inflation fears. Currency devaluation is another key driver. When central banks raise rates to combat inflation, it can put pressure on their currencies, but if inflation outpaces rate hikes, as it will with $200 oil, currencies will lose value relative to gold and silver. The US dollar may initially strengthen as a safe haven, but over time, persistent inflation will erode its value, making gold and silver even more attractive. As geopolitical chaos often accompanies high oil prices. After all, many of the world's largest oil producers are in unstable regions. Tensions in the Middle East, Eastern Europe, or South America could escalate as countries compete for limited energy resources, and investors will flock to gold and silver as a hedge against uncertainty. Similarly, systemic financial stress, banks struggling, stocks crashing, bonds collapsing, will erode faith in the financial system, and gold will be seen as the ultimate safe asset when all else fails. When faith in fiat money and central banks drops, gold rises, and a $200 oil shock will test that faith like never before. Expect gold to hit new all-time highs, potentially surpassing $6,000 per ounce, and silver to follow suit, possibly topping $100 per ounce. 3. Defensive and necessity stocks. No matter how expensive energy gets, people still need to eat, heat their homes, and get medical care. That's why defensive and necessity stocks will not just survive a $200 oil shock, they will provide stability and even modest growth for your portfolio. These stocks are called defensive because they are less sensitive to economic cycles, demand for their products and services remains steady, even during recessions. Let's break down the key subsectors. Utilities are first on the list. Everyone needs electricity, gas, and water, regardless of how high oil prices go. Utilities are often regulated, which means they can pass on higher energy costs to consumers, within limits, protecting their profits. They also pay stable dividends, making them a reliable source of income during a crisis. While some utility stocks may see slight declines if energy costs rise too quickly, they will drop far less than the overall market. Even in recent months, as energy prices have fluctuated, utility stocks have maintained relative stability, outperforming more volatile sectors. Consumer staples are next. These are the products people can't live without: food, household cleaning products, personal care items, and basic clothing. Companies like Procter & Gamble, Coca-Cola, and Walmart fall into this category. While these companies may face higher input costs due to oil prices, they have strong brand loyalty and pricing power, meaning they can raise prices to offset higher costs without losing customers. As a result, their profits remain stable, and their stocks hold up well during economic downturns. Even in a recession, people will still buy bread, toothpaste, and laundry detergent, making consumer staples a portfolio anchor. Healthcare is the third key subsector. Medical care is a necessity, not a luxury. People will still need doctor's visits, prescription drugs, and hospital care, even if they're cutting back on other expenses. Pharmaceutical companies, healthcare providers, and medical device makers are all part of this category. While some healthcare stocks may be affected by government spending cuts during a recession, the overall demand for healthcare remains steady. Additionally, many healthcare companies have strong balance sheets and stable cash flows, making them a defensive play. Even as the broader market fluctuates, like the 1.42% decline in the investment-grade defensive index in recent weeks, healthcare stocks have maintained resilience. These stocks act as a portfolio anchor. They don't offer the same upside as energy stocks or gold, but they prevent your portfolio from collapsing entirely. They drop much less than the overall market and often pay stable dividends, providing you with income while you wait out the crisis. 4. Strong cash and short-term U.S. Treasuries. Cash and short-term U.S. Treasuries may not seem like growth assets, but they are critical to your survival in a $200 oil world. Think of them as your dry powder, the capital you keep on hand to protect yourself from losses and seize opportunities when the market crashes. First, cash preserves capital. When stocks, bonds, and real estate are crashing, cash holds its value, even with inflation. It's the only asset that doesn't decline in price during a crisis, making it a safe haven for your wealth. While inflation will erode the purchasing power of cash over time, it's better to lose a small percentage to inflation than to lose 30% or more on stocks or bonds. Second, short-term U.S. Treasuries, those with maturities of 1 year or less, pay high interest when rates rise. As central banks hike rates to combat inflation, the yield on short-term treasuries will climb, potentially reaching 6% or higher. This means your cash can earn a decent return while remaining safe, unlike long-term bonds, which will crash when rates rise. Short-term treasuries are backed by the U.S. government, making them one of the safest investments in the world. Third, cash and short-term treasuries let you buy crashed assets at huge discounts later. When the market hits bottom, and you'll have the capital to buy undervalued stocks, real estate, or other assets at a fraction of their pre-crisis prices. This is how smart investors build wealth during crises. They preserve capital when everyone else is panicking, then buy low when the dust settles. Without cash on hand, you'll miss these opportunities and be forced to sell your assets at a loss to cover expenses. Assets that will collapse after crude oil hit $200 per barrel. Just as important as knowing which assets to hold is knowing which to sell immediately. When oil hits $200 a barrel, these four asset classes will collapse, and holding onto them will destroy your wealth. Don't wait for the crash, sell them now to protect your portfolio. Point 1. High growth and unprofitable tech stocks. Why? Because high growth tech stocks, especially those that are not yet profitable, are built on one thing: cheap money. For years, these companies relied on low interest rates to borrow money, fund their growth, and attract investors, even if they weren't generating any profits. But when rates spike, as they will with $200 oil, the party ends. Higher rates make it more expensive for these companies to borrow money, which cuts off their access to the capital they need to grow. Investors, meanwhile, will flee these stocks in favor of safer, high-yielding assets, like short-term treasuries or dividend-paying stocks. Without cheap money and investor enthusiasm, unprofitable tech stocks will collapse. Many of these companies have already seen their valuations shrink in recent years as rates rose, and a $200 oil shock will push them over the edge. Think of companies in the crypto, SaaS, and biotech sectors that haven't turned a profit. These are the most vulnerable. Point 2. Cyclical and energy-intensive stocks. Cyclical stocks are tied to the economic cycle. They perform well when the economy is growing, but collapse when it shrinks. Energy-intensive cyclical stocks will be hit the hardest by $200 oil, because their costs will explode while demand collapses. Let's list the most vulnerable sectors. And airlines. Planes run on jet fuel, which is derived from oil. When oil hits $200, jet fuel prices will skyrocket, pushing airline costs to unsustainable levels. At the same time, consumers will cut back on travel, both business and leisure, due to higher prices and economic uncertainty, reducing demand for flights. Airlines will be forced to raise ticket prices, which will further reduce demand, leading to massive losses and potential bankruptcies. Shipping. Cargo ships run on heavy fuel oil, so their costs will surge with oil prices. Global trade will slow down as economic growth collapses, reducing demand for shipping services. This double whammy will crush shipping companies, especially those with large fleets and high debt. Autos. Cars run on gasoline, so higher oil prices will reduce demand for new and used cars. Consumers will hold on to their cars longer, and electric vehicles, EVs, will become more attractive, but EVs still make up a small percentage of the market, and auto manufacturers will struggle with lower sales and higher production costs. Many auto parts are made from oil-based materials. Manufacturing, retail, and chemicals. These industries are all energy-intensive. Manufacturing plants require large amounts of energy to operate. Retail stores need to heat and cool their spaces and transport goods, and chemicals are derived from oil. Higher oil prices will push up their costs, while lower consumer demand will reduce their revenue. Many of these companies will see their profits evaporate, and their stocks will collapse. Point 3. Long-duration bonds. Bonds and interest rates have an inverse relationship. When rates rise, bond prices fall. Long-duration bonds, those with maturities of 10 years or more, are the most vulnerable to rate hikes, because their cash flows are locked in for a longer period. When rates spike, as they will with $200 oil, long-term bonds will crash in value. For example, a 30-year U.S. Treasury bond with a 3% yield will lose significant value if rates climb to 6%. Investors can buy new bonds with higher yields, so the old bond becomes less valuable. Even government bonds, which are considered safe, will not be immune. Corporate long-term bonds are even more vulnerable, as the risk of default increases during a recession. If you hold long-duration bonds, sell them now. They will only lose more value as rates rise. Point 4. Over-leveraged companies and real estate. High debt plus high interest rates equals defaults. That's the formula for disaster when oil hits $200 a barrel. Companies and individuals with high levels of debt will struggle to make their loan payments as rates rise, leading to defaults. bankruptcies, and foreclosures. Over-leveraged companies, those with high debt-to-equity ratios, will be the first to fall. They will face higher interest payments, reduced revenue, due to the recession, and difficulty refinancing their debt. Many will go bankrupt, and their stocks will become worthless. Real estate, especially commercial real estate and highly leveraged housing, will also collapse. Commercial real estate, office buildings, retail spaces, hotels, will suffer from lower demand. Offices will be empty as remote work remains common, retail spaces will be vacant as consumers cut back on spending, and hotels will see fewer guests. At the same time, property owners will struggle with higher mortgage rates and maintenance costs, leading to defaults and foreclosures. Highly leveraged housing, homes with large mortgages, or investors with multiple rental properties, will also collapse as mortgage rates rise, making monthly payments unaffordable. Home prices will plummet, leaving homeowners underwater, owing more on their mortgages than their homes are worth. Now we need to talk about your $200 oil survival portfolio. Now that you know which assets to hold and which to sell, it's time to structure your $200 oil survival portfolio. This is a simple, defensive allocation that you can apply today. No complex strategies, no risky bets, just a balanced mix of assets that will protect you from inflation, benefit from high oil prices, preserve capital, and reduce volatility during crashes. Here's the breakdown. Adjust based on your risk tolerance: 20 to 30%. Gold and silver. This is your hedge against inflation, currency devaluation, and systemic stress. You can hold physical gold or silver ETFs like GLD or SLV, or gold mining stocks for higher upside. Given the current price levels, over $5,000 per ounce for London gold, this allocation will help preserve your wealth as oil prices surge. Aim for a mix of physical metals and ETFs for liquidity and stability. 20-25% energy and commodity producers. This is your growth component. These assets will benefit directly from high oil prices. Focus on integrated oil giants for stability, low-cost E&P firms for upside, and energy infrastructure companies for steady cash flows. You can also include coal and natural gas stocks to diversify within the energy sector. As geopolitical tensions persist and oil supply gaps widen, this allocation will deliver strong returns. 20-25%, defensive stocks, utilities, staples, healthcare. This is your portfolio anchor. These stocks will provide stability and dividend income. Choose large, established companies with strong balance sheets and stable cash flows. Avoid small-cap defensive stocks, which are more volatile. Even as the broader market fluctuates, these stocks will hold their value and provide consistent returns. 25-35%, cash and short-term U.S. Treasuries. This is your dry powder. Preserve capital, earn high interest, and be ready to buy undervalued assets when the market crashes. Keep cash in high-yield savings accounts or money market funds, and short-term treasuries in treasury bills, T-bills, or short-term treasury ETFs. This allocation ensures you have liquidity when you need it most, and it protects you from the worst of the market crash. Let's explain why this mix works. First, it protects you from inflation. Gold, silver, energy stocks, and defensive stocks all act as hedges against rising prices, ensuring your purchasing power doesn't erode. Second, it benefits from high oil prices. The energy and commodity producers in your portfolio will see their profits surge, offsetting losses in other areas. Third, it preserves capital for the recovery. Cash and short-term treasuries keep your wealth safe, so you can buy undervalued assets when the market hits bottom. Fourth, it reduces volatility during crashes. The defensive stocks and safe havens, gold, cash, will keep your portfolio from collapsing, while the energy stocks provide upside potential. This balance ensures you don't panic sell during the worst of the crisis. $200 oil would be one of the biggest economic shocks in modern history, on par with the 1970s oil crisis, the 2008 financial crisis, and the COVID-19 pandemic. It will disrupt global supply chains, crush consumer spending, and send financial markets into a tailspin. But here's the good news: you don't have to lose everything. The assets you choose today will decide whether you survive this crisis or get wiped out. Most investors will panic, sell their assets at a loss, and watch their wealth evaporate. But you don't have to be one of them. by holding the right assets, energy producers, gold, defensive stocks, cash, and selling the wrong ones, unprofitable tech, cyclical stocks, long-term bonds, over-leveraged real estate, you can not only protect your portfolio, you can thrive. If you want to know the exact signs to watch before oil spikes, like geopolitical tensions, supply shortages, or inflation data, subscribe and hit the bell. That's coming next. We'll break down the early warning signs so you can prepare even earlier. Now, comment below, are you preparing for $200 oil? Have you already adjusted your portfolio, or are you just starting to think about it? Your feedback helps us create more content that protects your wealth. This is Market Meridian. Stay safe, stay prepared, and we'll get through this together.